What if I told you the most powerful wealth-building formula ever used by Warren Buffett has nothing to do with luck, timing, or finding the next hot stock? It's not a secret, it's not complicated, and it's not reserved for billionaires. In fact, Buffett's entire fortune, now well over $150 billion, was built on two timeless principles: compounding and value investing. These aren't buzzwords. They're the backbone of one of the most successful financial journeys in history. Buffett calls compounding the eighth wonder of the world. And for good reason. While most people chase fast profits, Buffett plays a longer, smarter game. He lets time multiply his money. So what makes compounding so powerful? It's exponential growth. Not just earning on your original investment, but earning on your earnings, year after year, quietly, consistently. Let's say you invest $10,000 at a 10% return. With simple interest, after 10 years, you have $20,000. But with compounding, reinvesting those gains each year, you'd end up with over $25,900. In 20 years, over $67,000. In 30 years, $174,000, without ever adding another dollar. Now stretched at across 50, 60, even 70 years. That's what Warren Buffett did. But he didn't start with billions. He started young. He started small. And he never stopped. If you appreciate this kind of long-term thinking and want more insights to help you grow your wealth with clarity, hit that like button and subscribe. This is where we unpack real strategies, not empty hype. Buffett's first move, starting early. Warren Buffett made his first investment at 11 years old, buying shares of City Service for $38 each. He sold them for a small profit. But if he had held on to them and reinvested the gains, that modest start could have turned into millions. That moment wasn't just about profit. It was a spark, the first step into a lifelong commitment to letting money grow slowly and then suddenly. Learning from a master of value, Benjamin Graham. Buffett didn't build his empire alone. In his early years, he studied under Benjamin Graham, the father of value investing. From Graham, Buffett learned that the stock market isn't a casino. It's a mechanism for buying ownership in real businesses. Rather than chasing quick wins, he focused on identifying undervalued companies with strong fundamentals, buying them at a discount, and holding them long enough to let compounding do the rest. That's where Buffett's true genius lies. Not just in choosing winners, but in not interrupting their growth. Case study, Coca-Cola. In the late 1980s, the stock market was shaky. Coca-Cola's share price had dropped. Most investors were running for cover. But Buffett looked deeper. He didn't just see a beverage company. He saw a global brand, unmatched distribution, loyal consumers, and decades of consistent cash flow. So what did he do? He invested over $1 billion into Coca-Cola stock. That one decision has earned him more than $25 billion in returns. And he never had to sell. Why? Because the dividends alone now pay him more annually than his original investment. That's the magic of compounding. Buy well. Hold long. Let time multiply. Patience is a strategy. Buffett's investment style may seem boring to some, but boring is beautiful, especially when it works. He doesn't jump from trend to trend. He doesn't chase headlines. He waits. He watches. And when a great company trades below its value, he acts. Most people try to beat the market by being fast. Buffett beats the market by being right, and by being patiently right for a long time. Another classic example, American Express. Let's rewind to the 1960s. American Express got hit by the Salad Oil scandal, a case of massive financial fraud that tanked the stock and shattered investor confidence. Most people ran. Buffett didn't. He looked at the core of the business, a strong brand, loyal clients, and a service that still mattered. He knew trust in financial institutions doesn't disappear overnight. So he doubled down, and that investment went on to produce billions in returns. He didn't just see what was happening. He saw what it meant. This is another key lesson. Buffett doesn't buy when everything looks great. He buys when others are fearful. Be fearful when others are greedy, and greedy when others are fearful. It's not just a quote. It's a principle, and it shows up again and again in his decisions. In the next part, We'll look at how Buffett turned panic into profit with Bank of America, why avoiding bad investments is just as important as picking good ones, and a surprising reason why not understanding something is reason enough not to invest. But before we get there, let's hear from you. What's one investment you wish you had held longer? Drop it in the comments below, because sometimes the best lessons come from the stories we share. Warren Buffett has proven one thing over and over. You don't need to move fast, you just need to move smart. While the average investor panics during crises, follows headlines, or chases hype, Buffett does the exact opposite. He waits, he studies, he prepares, and then, when the world is fearful, he strikes. Let's look at one of his greatest plays in modern history, Bank of America. Buying into fear, the 2008 crisis and beyond. After the global financial crisis in 2008, confidence in banks had collapsed. Bank of America was bleeding. Investors were dumping their shares. The media was screaming risk, collapse, instability. Buffett didn't flinch. He structured a deal to buy preferred shares in Bank of America with a 6% dividend yield, along with warrants, giving him the right to convert into common stock later at a fixed price. It was a masterstroke. When Bank of America recovered, the common shares surged. Buffett's position grew to be worth tens of billions of dollars, not because he was aggressive, but because he was disciplined. He bet on the recovery of a fundamentally strong institution when others saw only fear. And the returns? Historic. Buffett's real edge isn't just what he buys, it's what he avoids. Here's something that rarely gets the spotlight. Warren Buffett is not only great at finding opportunities, he's world-class at saying no. In fact, that may be his biggest advantage. The difference between successful people and very successful people is that very successful people say no to almost everything. Warren Buffett. Buffett does not invest in things he doesn't understand. This is why he avoided tech stocks for years, even as the market rushed into them. While others speculated on internet startups in the early 2000s, Buffett sat on the sidelines. He wasn't being stubborn. He was being smart. He believed most of those companies were overvalued, undertested, and overly hyped. He didn't understand their long-term durability. And without understanding, there's no conviction. He was right. The dot-com bubble burst. Billions were lost. And Buffett remained untouched. But then, Apple. Later, Buffett shocked many by investing billions into Apple. Why? Because he finally saw a tech company that wasn't just tech. Apple, to Buffett, was a brand. It had consistent, predictable cash flows, deep consumer loyalty, a moat that few companies could replicate. And it wasn't just about iPhones. It was about ecosystem dominance and recurring revenue. He invested in 2016, and since then, that one decision has earned Berkshire Hathaway over $100 billion in profit. This proves a key point. Buffett doesn't reject change. He waits until value is clear and sustainable. He moves when the fog lifts, not before. The importance of simplicity. Buffett doesn't complicate things. He's not trying to outguess algorithms or make 15 trades a week. His system is brutally simple. Find great businesses. Buy them at a good price. Hold them for a long time. This is what most investors miss. They get caught up in noise. They refresh charts, track earnings, panic on headlines. Buffett? He reads. He waits. And when others overreact, he stays the course. The stock market is designed to transfer money from the active to the patient. Warren Buffett. Discipline over drama. Most people believe successful investing is about doing more. Buffett proved the opposite. It's about doing less, but doing it right. He doesn't trade emotionally. He doesn't follow momentum. He doesn't check prices 10 times a day. And yet, he outperforms those who do. This brings us to one of his most underrated strategies, holding through boredom. Yes, boredom. Buffett has held some of his stocks for decades, watching them slowly but consistently grow, compound, and reward. One of his best examples? The long game with GEICO. In the 1950s, Buffett discovered GEICO, a small insurance company disrupting the industry with a direct-to-consumer model. He bought shares early. He watched the company expand. He waited not months, but years. Eventually, he bought the whole company outright. Today, GEICO is one of Berkshire Hathaway's crown jewels. The lesson? Most people look for fast profits. Buffett looks for inevitable growth, even if it takes time. He's not just playing the market, he's playing time. And that's how compounding works best. Not in spikes, but in slow, relentless, exponential curves. In the next part, we'll bring it all together. The simple formula behind Buffett's success, how anyone, yes, even with a small portfolio, can apply it, and why ignoring short-term noise is one of the most profitable decisions you'll ever make. In the meantime, here's something to think about. How often do you check your investments? And has that habit actually helped you grow wealth? Share your honest take in the comments. Your reflection might challenge someone else to invest with more focus. At this point, one truth should be crystal clear. You don't need to be Warren Buffett to invest like Warren Buffett. His wealth wasn't built by chasing the market. It wasn't built by guessing what would happen next quarter. It was built through a disciplined approach anyone can follow. So, what exactly is the Buffett formula? It's not magic. It's not about IQ. It's not about being born in the right family. It's a mindset, a repeatable process. Find great businesses you understand. Buy them at fair or undervalued prices. Hold them for decades. Let compounding multiply your returns. Ignore noise, hype, and short-term panic. That's it. No shortcuts. No secret signals. Just clarity, patience, and time. But what if you're just starting? Here's the good news. You don't need millions to begin. Buffett himself has said that if he were managing a small portfolio today, he could generate extraordinary returns simply by sticking to his core principles. And for those who don't want to study balance sheets or analyze businesses in depth, he gives a straightforward recommendation. For most people, the best thing is to invest in a low-cost S&P 500 index fund. Why? Because over time, the overall market goes up. And if you consistently contribute, reinvest your dividends, and don't panic during downturns, compounding will take care of the rest. In fact, if Buffett had done nothing but invest in the S&P 500 over his lifetime, he still would have become a billionaire. That's how powerful long-term investing is. The real threat, impatience. Most investors fail not because of the market, but because of their own behavior. They jump from trend to trend. They buy high and sell low. They check prices constantly and panic when things get volatile. They forget that real wealth is built over decades, not days. Buffett's edge is his emotional discipline. He doesn't let fear drive him. He doesn't chase popularity. He plays a different game, one where time is his greatest asset. The unseen side of Buffett's wealth. People often focus on Buffett's brilliant stock picks, but they miss what might be the most important element of all. He started early and he never stopped. Buffett began investing at age 11. He stayed in the game. He reinvested his gains. He didn't cash out when he could have. He let compounding grow quietly in the background. If you take away anything from his story, it should be this. Start now. Stay consistent. Stay invested. Even if you're in your 30s, 40s, or beyond, it's not too late. What matters is not time in the market, but time in the market. And you don't need to pick the next Apple or Coca-Cola. You just need to avoid big mistakes. Stay disciplined and let your portfolio work while you focus on building your life. Final thoughts. Warren Buffett's $150 billion fortune is not about genius. It's about knowing what works and doing it relentlessly. It's about having the patience to let simple decisions pay off big over time. And most of all, it's about believing in the power of the long term when everyone else is looking for the shortcut. So whether you're investing $100 or $100,000, the rules are the same. Be curious, be cautious, be consistent, and never underestimate the power of time. One last thing before we wrap up. If you've made it this far into the video, chances are you're the kind of person who values real knowledge over hype. And yet, many people who watch these videos every week still aren't subscribed to the channel. If that's you, take a second right now to check. Are you subscribed? Is the notification bell on? That's how you'll know the moment we release the next insight that could shift your financial path for good. Because the right idea at the right time might just be the beginning of your own $150 billion story, no matter where you're starting from.